Every collapse begins somewhere. Often, it starts with a subtle shift, almost invisible to those in the system. One small movement, one overlooked connection, one domino leaning slightly to the side. And yet, that single quiet disturbance can set off a chain reaction far beyond imagination. History shows this again and again. Financial systems are complex networks: banks, hedge funds, markets, corporations, all connected by contracts, obligations, and confidence. Each node is stable on its own. Each domino appears secure. But the moment one falters, it can tip the next, and the next, until the entire structure moves as if preordained. What makes this domino so dangerous is that it is rarely recognized. Unlike leverage or liquidity that can be quantified, this is behavioral and systemic. It resides in the trust people have in the system, in the assumptions made across institutions, in the confidence that someone else will handle it. It is invisible until it is not. Take a look at past crises. In 2008, the first domino was a seemingly isolated default in subprime mortgages. Few realized that it was linked to trillions in derivatives, to global banks with interwoven obligations, to pension funds and insurers relying on stability. That one default did not destroy the world alone, but it revealed the network, exposed hidden risks, and pushed other dominoes over. What seemed contained was anything but. Today, the dominoes are larger and more complex. Shadow banking, high-frequency trading, leveraged derivatives, and global interconnectedness have expanded the system. One small disturbance in an obscure market or instrument can cascade quickly. The first domino might not be seen until it triggers a reaction hundreds or thousands of miles away in a bank, a hedge fund, or even a government treasury. Confidence amplifies the danger. When participants believe the system is sound, they take on more risk. Leverage rises, positions grow larger, and the invisible domino becomes heavier. The very success of a market creates fragility, just as calm seas conceal the depth of hidden rocks below. Liquidity is another critical factor. Markets move smoothly only when buyers and sellers exist on both sides. When the first domino nudges uncertainty, liquidity can dry up. Selling begets more selling, while buyers retreat into caution. The chain reaction accelerates as hesitation replaces participation. What was a minor wobble now becomes a cascade. This domino does not operate in isolation. It interacts with confidence, liquidity, leverage, and human psychology. Market psychology plays a crucial role. Herd behavior magnifies the impact. Fear spreads quickly, and panic becomes contagious. One institution's action triggers reactions from others, and the movement amplifies exponentially. Policy and regulation can mitigate or worsen the situation. In moments of extreme stress, intervention may stabilize or may fail to reach the core problem. Timing is crucial. Too late, and the domino topples. Too early or misdirected, and it may simply shift risk to another part of the system. The key lesson: the first domino is rarely recognized in real time. By the time it is obvious, the cascade is already underway. Systems that appear strong are often just balanced on a single point of vulnerability. And the most important part? This domino is not always financial in nature. It may be social, political, or psychological. A sudden shift in policy, a geopolitical shock, or even mass sentiment can trigger financial dominoes, demonstrating the system's fragility is never purely economic. Understanding this domino requires thinking differently. It requires seeing the connections between institutions, markets, and participants. It requires imagining a sequence of events that may not have happened before, the plausible but improbable. It requires humility, recognizing that stability is often an illusion, and that the next collapse will not necessarily resemble the last. The hidden domino teaches us about human behavior as much as finance. Greed, fear, and complacency interact with structures and models in unpredictable ways. Systems are designed by humans for humans. No algorithm, regulation, or safeguard can eliminate the inherent unpredictability introduced by human judgment. As we study the past, we see patterns: the quiet accumulation of risk, the normalization of deviations, the slow erosion of safeguards. All of it builds invisible weight on the first domino. Then, one day, a small nudge, a missed margin call, a default, a sudden withdrawal begins a chain reaction. By the time it is visible to the outside world, the collapse seems sudden. But in truth, it has been building for years, quietly, invisibly, inevitably. Every market participant is connected to this sequence, whether they realize it or not. Traders, investors, banks, regulators, governments, all are linked through obligations, confidence, and perception. When the first domino tips, the consequences spread through every layer of the system. Positions unwind, capital evaporates, and decisions that seemed rational in isolation become catastrophic in combination. And yet, the story does not end with collapse. From each domino sequence comes insight. Systems are rebuilt. Lessons are learned. Safeguards are introduced. Confidence slowly returns. But history shows that the next domino is always waiting, often in a form nobody anticipates, in a corner nobody watches, behind a connection nobody considers. The domino no one saw coming is both a warning and a guide. It teaches us that fragility exists even in calm waters. Stability is conditional, and that financial systems are as dependent on human behavior as they are on money itself. Understanding these sequences gives perspective, insight, and perhaps a sliver of control in a world where the invisible forces often dominate. Every collapse begins somewhere. Every crisis has a first domino. The challenge is seeing it before it moves, and understanding that even a single tilt can reshape the world. This is the story of the domino no one saw coming. A story of risk, confidence, human behavior, and the fragile beauty of the systems we rely on every day. Welcome to Cash Chronicles, where money, power, and history collide.